To understand the financial health of any business, one of the most important concepts to grasp is COGS, cost of goods sold. This metric includes all the direct costs involved in producing or acquiring the products or services a company sells. These direct costs can include things like raw materials, manufacturing labor, and any expenses specifically tied to the production process. Without COGS, it's nearly impossible to calculate how profitable your business truly is. A key reason businesses track COGS is to calculate gross profit, which is the amount of money left over after subtracting these production costs from your total sales revenue. The formula looks like this. Gross profit equals revenue minus COGS. Revenue is the total amount of money a business earns from selling its products or services. COGS represents the costs directly related to producing those products or services. The difference between these two gives you gross profit, which is a critical measure of your business's efficiency and financial performance. Let's go through an example to make this clearer. Imagine your business sells custom-made furniture. In one quarter, your company earns $200,000 in revenue from sales. To make the furniture, you spent $80,000 on wood, screws, glue, and other materials, plus the wages of workers directly involved in the production process. Subtracting your COGS from revenue leaves you with a gross profit of $120,000. Now, let's consider a different scenario where your production costs are higher, say $150,000. After subtracting that from the same $200,000 revenue, your gross profit would drop to $50,000. This significant drop would likely raise a red flag. Why are your costs so high? Are you paying too much for materials? Is your production process inefficient? Why does this matter for your business? Gross profit isn't just a number. It's a key indicator of your business's overall health. A higher gross profit means your production costs are under control, leaving more money available to cover operating expenses, taxes, reinvestments, or even savings. On the other hand, a low gross profit could signal trouble. It might mean you're spending too much to produce your products, pricing them too low, or both. How can this information help you improve? Tracking COGS and gross profit gives you insights that can help you make better decisions. Reassess pricing strategies. If your gross profit is too low, consider whether your prices are high enough to cover production costs and still leave room for profit. Identify cost-saving opportunities. High COGS might mean it's time to renegotiate with suppliers, find more affordable materials, or streamline your production processes. Focus on profitable products. Understanding which products have the highest margins lets you prioritize selling items that bring in the most profit. Plan for growth. A healthy gross profit margin gives you the confidence to reinvest in your business, whether it's through marketing, hiring, or expanding your product line. COGS doesn't just help you manage day-to-day operations, it also plays a role in long-term financial planning. It affects other financial metrics, like operating margins and even tax liabilities. For beginners, the takeaway is this. By keeping a close eye on your COGS and understanding its impact on gross profit, you're better equipped to evaluate your business's performance. This empowers you to make smarter decisions about pricing, cost management, and growth strategies, all essential steps toward building a sustainable and profitable business.